I guess there's three things. One is the fundamentals are still there. The second thing is the reasons people have been buying gold still remain intact. That certainly hasn't changed. And the third thing I would say is that there is no mania.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025 while supplies last. First this week, 1-ounce Gold Philharmonics are just $99 over spot. Next, 2-ounce Silver Canadian Rocky Mountain coins are only $4.50 over spot per ounce. Finally, Kilo Silver Britannia coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Adrian Day from Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Good afternoon, and thank you for having me, Elijah.
Well, it's great to have you today. I did want to discuss what it really has shocked people over the last few trading days, as we've seen just a plummeting price in gold and silver after we've seen, tremendous rallies over the last couple of months. It was interesting. It's just interesting to see how, prices are back where they were, a week or two ago, but, everyone is freaking out about this huge pullback. So it is kind of an interesting dynamic. It went up so fast and now it's come down so fast. So your take on kind of the where we are right now, and has this changed your long-term outlook at all?
Yeah, no, and you're absolutely right. If you put a sort of blank piece of paper over the last week, over the last 10 days, and just looked at gold going from 3,300 in August to over 4,000 today, you would be delighted, right? If you'd been away on a vacation somewhere for the last 2 weeks and didn't know it had got even higher. So, I think if we look in this in context, yes, this is absolutely, the last 2 days we've had absolutely very sharp declines. But if we look at it in context, I'll say a few things. First of all, you said, we're only back to where we were less than 2 weeks ago, less than 2 weeks. Second point I would make is that even this dramatic decline for the last 2 days, as dramatic as it is less than 30% of the rally from September. So, and given that rally, as you said, was so extraordinarily sharp, when you have a pullback, you expect a pullback, frankly, of as much as 50 or even 60% of the rally as a retracement. So we haven't seen that yet. And if you look back, whether it's 2020 with COVID or 2011, 2009, 2006, we've had declines similar to this in the past. This is not, I've heard people say unprecedented. This is not unprecedented at all. And that's before you even go back to 1974. So I guess what I'm trying to say is, just to put a bit of context on it, we had that very, very dramatic move from the end of August until, Monday. It was unclear how long it was going to go. And my take is that nothing fundamental has changed. I think the move was certainly overdone, and I use the expression several times, overbought, but are still underowned. There's no question it was overbought, and there was nothing fundamental yesterday that set off this decline. That's important for people to realize. It wasn't that central banks suddenly said, we don't need to diversify away from the dollar anymore. It wasn't that, we've got both in Gaza, the peace is looking a little bit fragile, but particularly in Ukraine, with no meeting between Trump and Putin. There was, if anything, the news was gold bullish. There was nothing that caused this other than just the market dynamic, that it had moved too far, too fast, and there were people looking to take profits and buyers saying, well, let's just wait a little bit. So that's my take. And so long term, I think, or long-term, medium-term even, the drivers of gold for the last 3 years, the people buying gold and the reasons they were buying gold, nothing has changed. And I'll just say, for example, central banks, which have obviously been the most important buyer for the last 3 years, particularly particularly 23, 24, and the beginning of this year, they've been almost holding gold up alone. If you look at the central banks, they're diversifying away from concentration in a single asset, an asset of a country that is fiscally irresponsible, and added to that a country that is using its dominance, it's weaponizing its dominance, both with the dollar and with the SWIFT system. And this has been going on a while, and that's the point that I would want to estimate. Both the weaponization of the dollar and also the central bank's diversification away from the dollar has been going on for a while. If you go back to 1999, the beginning of this century, in aggregate, central banks had 78% of their foreign reserves in the dollar, 78%. And by foreign reserves, we mean for the Bank of England, not the British pound, for the Bank of Japan, not the yen. So foreign reserves, 78% were in the dollar. 5 years ago, that was down to about 65%. Last year, according to the IMF, it ended the year at 58%. And in August, the ECB said it was 48%. And so this has been going on a long time. And what I would say is that the drivers, nothing has changed. I'm not going to get political, but I would say even if this administration didn't start the onslaught, they've done nothing to change it or to stop it. And if you're a central bank worried about concentration of a single asset from a fiscally irresponsible government which might weaponize its dominance, well, I ask the question, is 48% still too much? And I would say 48% is still too much. So we're going to get continued reduction in the dollar. And remember, these countries are continuing to earn dollars all the time. So we're going to get continued reduction in the percent in the dollar. And where is that going to go? Some will go to the euro. The euro is at about 22% of central bank's foreign reserves. For the aggressive ones, some will go to the yen, or some might go even to the Australian dollar or something. But this is at the margin. Most of those assets, other than the euro, most of those assets are going to go to gold. And that's going to continue, in my view. That was a long answer, I'm sorry, but I just wanted to sort of set the scene.
No, very insightful there. And you mentioned that what just happened in precious metals parallels to what we've seen in bull markets in the past. So it's nothing unusual. You didn't mention the 1980 when gold dropped significantly, or 2011 when gold and silver dropped significantly. So those two times, why do you think right now is, because some people are concerned, right? Is the bull market over? But I guess what you're saying is the fundamentals are still there, unlike in 1980 or 2011.
That's right. So I guess there's three things. One is the fundamentals are still there. The second thing is that the reasons people would, as I just said, the reasons people have been buying gold still remain intact. That certainly hasn't changed. And the third thing I would say is that there is no mania. I don't know how it is for you, and you can say if you want or not say if you want, but some of the coin dealers I talk to will tell me that up until the last week, even if they've been busy, it's been as many people calling to sell gold and silver as it is to buy gold and silver. When you look at most mutual funds, and I'm not talking about our mutual fund now, and we're not allowed to give out information before it's been publicly released. I'm not talking about ours, but I can tell you that most gold mutual funds, and I'm talking now obviously about equities, but most gold mutual funds have been seeing ongoing outflows. for GDX, which is the minor ETF, if you look at the last month, it's had a small inflow, net inflow. But, for the last 2 months, 3 months, 4 months, it's been outflows. And the point I'm making is that there is no broad public participation in this market. And you cannot have a top. It's impossible to have a top in a market, by definition almost, without public participation. 1980, you certainly had public participation. You will remember, even though you weren't alive, you've seen the pictures, I'm sure, of people lining up at coin dealers, lining up around the block to buy gold. We haven't had this at this time. So no mania, very, very little in the way of public participation. And so I just, for those reasons, I just don't think it's a top.
Right. I mean, here at Miles Franklin, the last month and a half has been a lot more busy, and premiums have increased on some of the popular products, U.S. gold and silver eagles here. But it doesn't seem like it's like what we've seen in the past, like even during bull markets, right? So in 2023, when Silicon Bank collapsed, we saw huge demand, or during the silver squeeze, or during COVID and all that kind of stuff. So it's a lot of demand. It's a lot of people selling as well, but it doesn't seem like a huge mania, especially that it's only lasted about a month and a half here.
Right. And so gold has to have that manic public participation before you can have a top. And, we know the gold in particular, but also silver. Gold and silver are very difficult to they're difficult to come up with what is the fundamental value, because, with a company that makes widgets, you look at their sales revenue, and you look at their price to sales and their price to earnings, and you look at whether their costs are going up, and you look at the dividend it pays. When you look at gold, well, it doesn't pay a dividend, as we know. The detractors keep telling us it doesn't earn anything. Okay. So what do you value it on? So you can value it on, the price of gold today, inflation adjusted compared with previous highs. That's one metric. But I don't think it's a be all and end all. Apart from anything else, the CPI is a very, very unsatisfactory metric to use. Now, if we went back to 1980 and used the methodology that they were using back in 1980 and used that the whole way through, well, you'd find gold is still not particularly expensive. It's more or less the same. It's more or less just kept pace with inflation over that period. You can look at gold versus the money supply, U.S. money supply, global money supply, U.S. versus debt, gold versus debt. All of these are sort of metrics you can use that give you a gauge. No one is perfect. As with a widget manufacturer, you can say, well, I'm looking at the price to earnings. Right? But you can't do that with gold. But all of these metrics, and then other people will look, and one of my favorites, frankly, is the gold to Dow. So gold versus financial assets. And that one is very, very telling. Certainly we're off the bottom. No question about that. And we're perhaps meaningfully off the bottom. But we are so far from those lows, that is gold, the Dow being at a low to gold, or highs, I should say, gold high relative to the Dow. We are so far from those points that we've seen in the past and have typically indicated a fundamental top for gold and a long-term, decline. We're nowhere near that. We're still closer to the bottom than we are to the top. So on all those metrics, I think we can argue different ones will give us something different. But not one of them is saying that gold is overvalued right now.
And even within the precious metal sector, the gold-silver ratio seems to sometimes give us an indicator, like in 1980 falling to about 16 to 1, 2011 falling about 33 to 1. Right now at 80, 85 to 1. I mean, it's hardly off its highs there.
Exactly. And I should just say, I'm not someone who puts, all of my investment faith into this gold-silver ratio. I don't honestly think it's necessarily as valuable as it was. But again, it is certainly one of the metrics, one of the indicators to look at. And yeah, you're absolutely right. On that particular factor, silver is just still remarkably undervalued. It's only just hit its nominal high, right? Let alone its inflation-adjusted high. So yeah, I would agree. The gold is still undervalued, and silver is even more undervalued.
Now, zooming out again to the long-term perspective, because I think it's so important, because people can look at these day-to-day price fluctuations and kind of lose the forest for the trees, right? You mentioned the financial assets versus gold, and how stocks are still, the general stock market is still overvalued compared to precious metals. Did you want to give our viewers an outlook on this? Because I know on your recent quarterly newsletter, you mentioned how really caution is warranted with respect to the general stock market right now.
Well, my view for a little while has been that the risk in the market is increasing, even as I see the possibility for the market to continue to go up. And that is not contradictory at all. I mean, you can have a lot of risk that doesn't what's the expression? What would I say? Doesn't come to fruition. And I'll never forget my friend Bill Barner, gave a wonderful analogy of the guy that's at the party, gets absolutely stone drunk. It's 1 o'clock in the morning. He gets into a car. He speeds home at 80 miles an hour on 30 mile an hour speed limit streets, and finally stumbles into bed. Well, the fact that he arrived in bed safely does not mean there was not any risk. And it's the same that I see with the stock market right now. So number one, it is overvalued on any fundamental basis, and I don't know how anyone can dispute that. Number two, the breadth has become even more narrow than it was. At the end of last year, it was an all-time record, the narrow breadth, meaning there's only a handful of stocks that lead in the market, and it's got even narrower over the last 10 months. So the breadth is really narrow. There's a lot of different indicators that market technicians use, the Hindenburg omens or whatever, and so on. And I'm not going to get into all of those, but all of these indicators are flashing red. And perhaps the most important one would be this ratio of insider sales to purchases. Now, there's a lot of reasons that insiders might want to sell, a lot of reasons. But there's only one reason that you buy in the market, unless you're trying to pump up your stock price. There's only one reason you buy in the market, and that is that you like it. And when the ratio of insider sales to buys is so overwhelmingly on the sell side, a multi-decade high, all of those four are indicators that the market is stretched and the next major move will be down. But none of what I've said will tell you when it's going to happen. Certainly doesn't tell you it's going to happen tomorrow morning. But from an investment point of view, I think what it does tell you is that there is increasing risk in the market. And so we're just being very, very cautious with what we buy. We're buying defensive stocks, which will tend to go down less than the rest of the market, or dividend-paying stocks, which will give you a dividend even if the stock price declines. And mostly, frankly, we're just holding cash. We're just holding cash instead of buying stocks. And now we're also buying global stocks, I should say that. But in terms of the U.S. market, I think it's just a time to be really cautious. And again, things will change probably just as suddenly, just as much without warning as they did in the gold market. You know, they say famously, they don't ring the bell at the top. You know, one day, after 5 up days, we're suddenly going to turn on the Bloomberg and the market will be down. And there may not even be a fundamental reason for it. It's just that you finally exhaust buyers. And the market stops going up. The thing about the stock market, particularly in the US, of course, is really important to understand, is that most of the money flowing into the US stock market comes from 401ks, so it's regular contributions. And so long as employment is still relatively strong and people are still employed, that money will still go into 401ks, and most of the 401k money, in my experience, will go into the US stock market. I mean, every year I get these, my clients will send me, oh, it's that time of year again, Adrian, you know, I've got to decide where my 401 contributions are going for the year ahead. And, you know, they've given me 5 choices. Well, it's US big cap and US small cap. There's probably a global fund in there somewhere. There's a bond fund or a treasury fund. And that might be it. There's no gold fund. There's no resource fund. There's no long short hedge strategy. There's no emerging market fund or anything. And so my clients who are educated on gold and like gold, they will say, well, I guess you're taking care of gold and you've got a lot in the foreign markets. I may as well just stick it in the S&P. And so I'm sure that is true for an awful lot of people around the country. Just keep it in the S&P. And so long as employment continues to be relatively strong, and I personally think it's the employment picture in the U.S. is much, much weaker than the headlines would suggest. But, you know, so long as we don't have broad layoffs and unemployment, I think that money is going to continue to flow. But again, like the drunk who finally gets into bed, doesn't mean that there's no risk. I heard a wonderful metaphor the other day. Somebody said, I know some of you want to continue dancing, well, until the party ends. Well, make sure you're dancing very close to the door.
Certainly. And there are some other sectors that you're looking at as well, that not just in precious metals, but other commodities that you're bullish on or turning bullish on at the moment. Oil and gas, you're saying a lot of the popular assumptions out there that are saying, you know, that lower prices are ahead are probably wrong. So what makes you at least turning bullish right now on energy?
Yeah, I mean, the main couple of sort of narratives about oil and gas over the last decade. Number one has been that huge increase in production from the U.S. shales. And the U.S. shales actually have contributed about 90% of the global growth in oil over that period. Now, I'll say it again because I don't want people to say, you misunderstand what I said. I'm not saying they represented 90% of production. I'm saying 90% of the global growth in production came from the shales. And they've just been a phenomenal, the huge increases in oil and gas from the shales has been fabulous. But as always, we extrapolate things way into the future. And people miss that the shales, most of the big shale fields have now peaked, and the remaining ones will probably peak, if not this year, next year. So we're not going to continue to see growth from the shales. Now, how long are those tails? I won't go into it because I'm not a whatever they call them, geophysicist or something. I won't go into all the details. There are reasons to think that the tails on shale are a lot shorter than the tails on traditional fields. But either way, they peaked. No one can deny that. And so we're not going to continue to see growth from the shales. That's number one. Number two, and what are the new fields that are going to replace it? That's another big question. What are the new fields that are going to replace it? And I'm not sure what they are right now. There is some offshore success, offshore Venezuela and Guyana, in that northern bit of South America, which might partly be the reason for President Trump getting interested in the narco boats down there. So that's a potential, but, the Brazilian offshore fields, the North Sea, all of these things, Mexico, we can't expect to give us another big boost in production. So the shale, which is 90% of the growth, is peaking, has peaked, and what else is going to replace it in the near term, we don't know. So that's number one. And the number two thing, of course, is just this whole green narrative that's taken place in the last 10 years, where people, even if you were not opposed on principle to oil and gas, and as you know, a lot of funds in Europe in particular were just refused to invest in oil and gas. But even if you weren't of that camp, you could see the writing on the wall with all these no more internal combustion cars by 2030, no more oil by 2040. Absolutely, totally unrealistic targets. And now, as you know, different countries are beginning to back away from some of those targets. But I do think that had a huge impact. It had a huge impact on the capital investment that the oil and gas companies made. And it had a huge impact on investment sentiment towards that sector. The sentiment towards oil and gas is weaker than anything else other than coal. I'm not sure there's anything else with a weaker sentiment. You look at the S&P, for example, 15 years ago, 20 years ago, oil and gas was 18, 20, 22% different years of the S&P. Right now it's less than 2%. It is such an out of favor sector. And if you look at, I gave a talk recently where I was saying to people, we may see a correction in gold, but this is not the top. I think gold and gold stocks have a lot further to go, but other things are even cheaper. Oil and gas relative to gold is at, I saw a table, I saw a table, and oil and gas relative to gold is at an unprecedented extreme. It's never been that cheap relative to gold. So I think for those reasons, because people are realizing that the shales have peaked, and even if they don't realize it, they have peaked, which means that the production's not going to go up, and the sentiment is shifting away from this. Well, we'll have no more oil and gas, in 15 years' time. So I think we're going to see oil and gas make a bit of a comeback. And there are some good companies. The only thing I would say is I would make sure whatever I buy, I would make sure they have a strong enough balance sheet that they can withstand another 6 or 12 months of current prices. Copper is another one, that's very cheap. Copper is very cheap relative to gold. And the copper story itself is a very strong one. We're simply not finding enough large copper mines. Large copper mines, that is something that's going to be in the top 20 global production. They're very, very rare, obviously, and if you look at even the top 10, you look at the top 10 copper producers right now, something like, 7 of them were pre-1960, and 5 of them were 19th century, started in the 19th century. We have very, very few large, really large copper mines come on. We've got a temporary problem at the moment, with Cobre Panama, which was about 2% of global production, shut down by the Panamanian government. You've got Grasberg, which is one of the top copper mines in the world, number 4, I think. That's closed down temporarily because of the accident they had there. And then you've also got temporary shutdowns or reductions at 2 other, top 10 mines. So right now there's a particular squeeze. But I guess the point I would make is that things like that are not rare, unfortunately, in the copper business. Copper mines are huge. As I say, they're old, which means they're very, very deep. And so mines, I remember 10 years ago when a mine in Chile had to close down temporarily because of an earthquake 200 miles away. But because they're so deep, these things will affect them. So the big question with copper to me is the global economy, and particularly the Chinese economy. China is still the largest consumer of copper, largest importer of copper. And so we have to watch the Chinese economy. If that slows, and there's mixed signals at the moment, the growth seems to be continuing okay, but it's moving towards a deflationary environment. Now, as you know, you can have growth and deflation. In fact, that's the ideal situation, right? To have economic growth and deflation at the same time. But more often than not, deflation might indicate weakness ahead. So that's something we have to watch. But other than that, even if the electric vehicles, which use more copper than internal combustion engines, of course, but even if, the demand for EV slows down, even if electrification goes slower than we expect, you make the most conservative assumptions on all of the different demand equations, these data centers and so on and so forth. Make conservative assumptions. And we still don't have enough copper from current production or from current projected production. We still don't have enough production to meet those demands. So, within 5 or 10 years, that's going to be resolved with higher prices, of course. Could be a new technology, but more likely than not, it'll be resolved with higher prices.
Fantastic. Well, Adrian, Dave, we really appreciate your time today and all your insights, especially during this crazy time in the markets. If our viewers are interested in learning more, they can go to Adrian Day Asset Management. We'll put a link in the description of this video where they'll find your newsletter and also the mutual funds that you run. Can you tell us a bit about that?
Yeah, well, we have separately managed accounts, which is my own firm, and those are global accounts. We invest around the world. And right now, actually, we're finding some pretty good opportunities in countries as diverse as Hong Kong and Britain. British stocks are very, very cheap right now. And we also invest in gold and resources. And then I also manage Peter Schiff's, it's called the Euro-Pacific Gold Fund. So I also manage that.
Fantastic. Any last thoughts that you'd like to leave with our viewers today?
Yeah, I guess the last thought is, I don't mean to sound a little condescending or patronizing, but the last thought would be not to freak out at this. We've been in worse situations before. Think back to the poor people in 1974 when gold dropped literally 50% in less than a month. And those who sold at that point, of course, missed the move from $100 to $850. So, yeah. So, I think that the lesson always is not to overinvest in any one sector. If you don't overinvest in a sector, then you can tolerate these times of what are euphemistically called volatility, but really is declines, right? Have you noticed how every time something declines, people just say, "Oh, there's a lot of volatility in the market today." You can tolerate that. It's only when you're over invested and overstretched that these things start to be start to be a concern. So I think I would just hold on, and in the equities, I would begin to pick away, look for some good opportunities.
All right. Well, Adrian, thank you so much for your time today once again, and God bless.
Thank you, and you. God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025, while supplies last. First this week, 1-ounce Gold Philharmonics are just $99 over spot. Next, 2-ounce Silver Canadian Rocky Mountain Coins are only $4.50 over spot per ounce. Finally, Kilo Silver Britannia Coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.